Hi guys. Well, I hope the picture's okay. I'm not sure if that picture looks pretty good. Okay, hopefully you can see me now. Okay, so let's have a quick catch up on where we're at with financial markets. So the markets are all up at the moment. The reason why they're up is because Nike and FedEx came out or expect to come out with really good figures, really good numbers. And what's going to happen is that there's probably going to be a rally towards Friday. Friday is more or less going into Christmas, so it's called a Santa Claus rally. And what's likely to happen is that you're going to end up having a market rallying or pushing higher as much as possible leading up to Christmas, because on Christmas you get this feel good factor and everyone's sort of happy and relaxed, go to visit family. And so it's all very nice. It all works really well as far as traders are concerned. So with the Dow up 500 points, it's probably going to try to push for the 34,000 and may even go to 34,500 by tomorrow, being aware, taking into account that the markets have come off significantly. Don't know if this is really good. This picture, maybe that's better. Don't know. Considering that the markets have come off dramatically since January, and of course, what you've got is you've still got a major liquidity problem. So what you have overall is from the beginning of the year with rising interest rates and the Fed cutting back on its liquidity provision and also buying back the bonds. So in other words, they've stopped buying back the bonds, they've reduced liquidity in the marketplace, and that's made it a lot more difficult for these companies to get funding. And when they have difficulty getting funding, then obviously they have to lay off staff and cut back on costs. Also, the corporate earnings with the increase of inflation and the increase of interest rates has affected corporate earnings, and therefore that's going to have a big impact on employment. So you find a lot of high tech companies that will be laying off staff now as a result of the cutbacks. Going towards the end of the year, the markets, as I said, will rally a little bit up until the end of December 2022. They'll try to claw back as much of their losses as possible from this year. And then what's going to happen in 2023, you're probably going to see a major correction as far as financial markets are concerned. You're probably going to see at least a 25-30% drop in equity markets across the board and a strengthening dollar. Remember, the dollar is rises on two factors. Number one, it's used as a safe haven when times of crisis, and second of all, with rising interest rates in the States, which are rising faster than Europe and the UK, then the dollar or the US assets become more attractive. So investors, traders have to then go convert their currency, their local currency, into dollars in order to invest in US assets or US equities or in the dollar itself. And that's going to cause the dollar to go higher in 2023. Equity markets also, as they fall, then the dollar will become stronger, because as equity markets fall, then the dollar is seen as a go-to asset. It's seen as an asset that, yeah, what we want to do, we want to grab those dollars because they're secure, they're safe, etc., etc. Looking across the board as which shares may perform next year and which may not perform, the only one I have an eye on actually is Microsoft, because Microsoft has a solid product and they've got a very good database, a very good client base. So I would see Microsoft probably as an outperform in 2023. However, I see the underperform or the ones that are going to lose money as the Apples, the Googles, the CRMs, Tesla, Netflix, etc., and of course Meta as the big ones. And then you've got all the other internet stocks that have lost huge amounts of money this year, anywhere between 70 and 80%, and they'll probably fall even further. So again, as I said earlier on, I expect Meta to fall to around about the $70 a share. Amazon to continue falling. At the moment, it's about $90 or $88. Expect that to fall to around about the $70 area. And then you've got all of the other ones which will fall another 25 to 30% when it comes to high risk investments or the high tech sector. Moving on to bonds in terms of 10-year treasuries, probably going to see the yield again creep up to about 4.3, 4.4. Remember, there is a divergence, a massive inversion between the 2 year and the 10 year. So people are expecting to get a better return on on the 2 year than they are on the 10 year, and that is a clear sign of a recession. It's gone on for more than 6 months. 6 months is the minimum. There needs to be an inversion between the 2 year Treasury and the 10 year Treasury. That's happened. That's going to continue, and that inversion is going to get wider. So you're going to get a wider divergence between the 2 year and the 10 year, and that's going to cost. That's going to cause. That's a clear lead indicator of recession, and of course, that is going to push up interest rates as the bond rises. Rates are going to rise, and mortgages are going to become a lot more expensive. You probably can expect also that. Property prices in the US are going to fall across the board in the UK and Europe, and you can also expect a 20-25% fall in property prices as far as real estate is concerned. Anyone who's a trader on cryptocurrency, well, you're well aware of my view on that one. I see Bitcoin falling well below the 15,000. Again, I was hoping it was going to happen by the end of this year, but if equity markets rise and there's a race on for risk, then you could see Bitcoin be well supported. But my view is, come in 2023, you're going to have a significant loss on cryptocurrencies. That's more or less it. This is the first live that I've done, so hopefully you've enjoyed it. Speak to you soon. Mayor Valensky with Driving Markets. Have a good day.